Okay, welcome to the deep dive.
Good to be here.
So today we're jumping into TKO Group Holdings and their Q3 2025 earnings. A quarter that leadership's calling historic.
Yeah, historic. Big word.
It is. But what does that really mean for them? Seems like it's about how they've strategically used, well, all that combat sports content they have.
Exactly. Used it to lock in a kind of new foundation, a more structurally sound future.
And the sources we're digging into.
Uh-huh. We've got the Q3 earnings call transcript and the official 10Q filing. Pretty standard stuff, but revealing.
Okay.
And yeah, they really show this was the quarter, the pivot point, you could say.
A pivot from what to what?
From just being a company with awesome content to being, well, a consolidated entity that throws off immense predictable cash. That's the key, predictable.
Gotcha. So our mission today is to kind of break down that scale of change, right?
Yeah, we need to look at those three big pillars they're building on.
Which are?
The aggressive capital return, those huge new media deals, and then how those deals are basically funding expansion.
Expansion into things like site fees and that new boxing stuff.
Precisely. Site fees, the boxing initiative, it all connects.
Okay, so before we dive into those pillars, let's set the stage with the big picture financials, because that really tells the story of their confidence.
Yeah, absolutely. For the third quarter straight, TKO raised its full-year guidance for 2025. That's pretty significant.
What are the numbers now?
They're targeting full-year revenue between $4.69 billion and $4.72 billion.
Okay.
And adjusted EBITDA, looking at $1.57 billion to $1.58 billion.
So bumping it up again, that signals real belief in the trajectory.
Totally. It's not just growth, it's predictable growth. And you need that when you're making big moves with capital.
And specifically for Q3, how did that quarter land?
Q3 revenue was $1.12 billion, solid number.
And the profitability?
Adjusted EBITDA hit $360 million. That keeps them right around that impressive 32% margin.
Right. So that stability, that cash flow they can see coming in, that's what lets them launch this pretty bold capital strategy.
You nailed it. That's pillar number one, returning value and managing the balance sheet. The focus was squarely on shareholders this quarter.
How so? What were the big moves?
Well, first off, a massive $1 billion stock buyback program announced. Just huge.
$1 billion. Wow.
And they didn't wait around. They immediately kicked off an $800 million accelerated share repurchase agreement, an ASR.
Okay, break down ASR quickly for, listeners who don't track this daily.
Sure. An ASR is basically just a way for a company to buy back a large chunk of its shares really quickly from an investment bank. Gets the shares off the market faster than open market purchases typically would. It signals confidence.
So quicker impact from the buyback.
Yeah.
What else for shareholders?
Dividends. If you held TKO stock, you saw your quarterly cash dividend double.
Double.
Yep, double.
Yeah.
To $0.76 per share. That's a 100% increase. Started with the September payment. A very clear signal of financial health.
Okay, big returns. But how are they funding this? Did cash flow cover it all?
Well, that's the other side of the coin. They also took on more debt. They secured a $1 billion incremental term loan in September.
Adding $1 billion in debt while returning $1 billion plus.
Essentially, yes. It increased their total term loan to about $3.7 billion. But look at the strategy. They're using relatively low-cost debt right now to buy back stock and boost dividends, betting that the guaranteed high-margin cash flow from their new media deals will easily cover the debt service and deliver better long-term value.
So leveraging the balance sheet based on future locked-in revenue.
Yeah.
That makes sense. They also refinanced, right? Pushed out maturities.
They did. Extended the revolving credit facility out to September 2030, and the term loan maturity now goes to November 2031. Gives them breathing room.
Okay, so they've got the financial structure shored up, they're rewarding shareholders.
Yeah.
All built on the confidence from Pillar 2, media rights mania.
This is really the engine driving everything else, the UFC deal.
Oh.
It's genuinely landmark.
The Paramount one.
Yeah. 7 years, $7.7 billion. Starting in 2026, all U.S. UFC content fights, everything goes to Paramount Plus and CBS.
And the key financial takeaway there is?
It basically doubles the average annual value, the AAV, compared to their old deal. Doubled it.
It is a massive step up. It really validates the UFC brand value.
Huge validation. And strategically, think about where it puts UFC. It's now in Paramount's portfolio alongside the NFL, the Masters, March Madness.
Talk to your sports company.
Exactly. Elevates combat sports right into that premier category of mainstream programming. Huge for reach.
Okay, massive reach, massive money. But moving off pay-per-view domestically, That has implications for fighter pay, doesn't it? That's always a hot topic.
It absolutely does. It's a structural shift away from fighters getting a direct cut of PPV buys, especially for the top stars.
So how did TKO address that? Because they need to keep those stars happy.
They tackled it directly on the earnings call. Leadership acknowledged that, yes, the structure of those premium contracts needs to change, moving away from that PPV back-end model. But they explicitly confirmed there will be an increase in overall fighter compensation. The goal is to keep pay competitive, consistent with maintaining their current profit margins, even with the model changing.
So pay goes up, but maybe structured differently? That sounds like a delicate negotiation ahead.
Definitely. It's a critical labor relations piece they have to manage carefully long-term.
Meanwhile, on the WWE side, they also scored a big media win.
They did finalize a 5-year deal with ESPN for their premium live events, or PLEs, in the U.S.
And the value increase there.
Also significant, over 1.8 times the value of the previous deal. So another big step up.
And that one launched early, right, with WrestlePalooza?
Yeah, ahead of schedule in Q3, streamed exclusively on ESPN's direct-to-consumer platform. And the cross-promotion was just wild.
You mean the college game day stuff?
Exactly. You had the game day panel, known for picking college football games, actually debating who would win a WWE match.
That's incredible integration. Shows how much ESPN is buying into the partnership.
Totally. That kind of mainstream sports legitimacy and promotion, you wouldn't have seen that 5 years ago. Speaks volumes.
Okay, so UFC to Paramount, WWE PLEs to ESPN, and then there's the boxing piece tying things together.
Right. The Zuffa Boxing joint venture. It officially launches in 2026, and guess where its U.S. media rights landed?
Let me guess, Paramount.
Bingo. Paramount gets U.S., Canada, and Latin America rights for Zuffa Boxing, so more combat sports consolidation onto that platform.
Interesting. Okay, so those deals set the future. How did the current business segments perform in Q3 before these deals fully kick in? Let's look at the segments.
Sure. WWE was the real standout this quarter. Strong engine.
Numbers.
Revenue up 23% year over year to $402 million. Adjusted EBITDA hit $208 million. Really solid performance.
What about?
Mostly the event calendar. They had 5 nights of PLE programming in Q3 25 versus just 3 in Q3 24.
More big events. SummerSlam was in there, right?
Yep, the first ever 2-night SummerSlam. And it was huge. Sold over 100,000 tickets, highest grossing PLE ever outside of WrestleMania. Demand is clearly soaring.
And partnerships look strong too.
Phenomenal growth, up 84%. They're landing major blue chip brands now. Think Maybelline, WWE's first ever official cosmetics partner.
Wow.
And JPMorgan Chase sponsored SummerSlam. It shows the brand is broadening its appeal, attracting advertisers beyond the usual suspects.
Okay, so WWE firing on all cylinders. What about the UFC segment in Q3? You mentioned the deal doubles later, but how is Q3 itself?
UFC saw a bit of a dip, actually. Revenue down 8% to $325 million. Adjusted EBITDA down 15% to $166 million.
Why the drop?
Timing, mostly. It was expected. They just have one fewer numbered event in Q3 this year compared to last year.
Right, and last year's Q3 had that massive Sphere event, UFC 306.
Exactly. You can't replicate something like Sphere every quarter. So the year-over-year comparison was always going to be tough because of that specific event timing.
But underlying demand was still strong.
Oh, absolutely. The live events, they did hold set records. UFC 319 was the biggest gate ever at Chicago's United Center.
Okay.
And when they went back to mainland China, sold out the arena in Shanghai in under a minute. The appetite for live UFC is definitely still there.
Got it. So timing, not underlying weakness. What about the third segment, IMG? That showed a big change.
Yeah, IMG revenue dropped 59% to $337 million. Looks dramatic on the surface.
But there's a reason.
A very clear one. It's purely because the 2024 Paris Olympics revenue was in the prior year's Q3 number. And that revenue isn't there this year.
And didn't TKO say the Olympics wasn't even profitable for them?
Ironically, yes. They noted it was actually a loss-making event included in last year's comparison. So taking it out makes the underlying IMG business look cleaner, even though the headline number drops.
So the core IMG on location business is still doing okay?
Yeah, momentum's still good there. They actually advised TKO on those big media deals we just talked about.
Internal synergy.
Right. And on location, their hospitality arm sold out 20,000 packages for the Ryder Cup. So they're performing well, despite the Olympic comparison noise.
Okay, that makes sense. Anything else notable, maybe in the corporate segment? PBR.
PBR Professional Bull Riders continues to build momentum. They had a Sunday broadcast on CBS in October.
Yeah.
Drew 2.7 million viewers. That's the biggest PBR audience since 2012. And get this, It actually beat the MLB playoffs and college football ratings in that same time slot that day.
Wow, bull riding beating baseball playoffs. That's
It
something.
tells you there's a real audience there. And surprise, surprise, PBR also just signed a 5-year deal to bring its main Unleash the Beast series to
Paramount Plus starting in 2026.
You got it. Everything seems to be converging onto Paramount.
Okay, so this stable, locked-in media revenue, that's the foundation. Now let's talk Pillar 3, future growth. How are they using this stability?
They're getting aggressive on growth levers, planning for 2026 and beyond. First big push, site fees.
Right, getting cities or venues to pay TKO to host events.
Exactly. And they're serious. They've set up a dedicated full-time team just focused on maximizing site fee revenue.
What's the strategy there? Just ask for more money.
It's kind of three-pronged. 1, get higher fees from markets that already pay. 2, start getting fees from places they currently visit for free. 3, break into totally new markets willing to pay top dollar.
And we're seeing proof of that already.
Absolutely. The biggest example is WrestleMania 43. It's officially scheduled for Riyadh, Saudi Arabia in 2027. That signals a major commitment to high-fee international locations.
And more Saudi events on the calendar generally.
Yep. If you look at the 2026 WWE calendar they shared, includes 3 PLEs in Saudi Arabia. That's up from just 1 in 2025. Clear direction.
Is there a risk, though? Relying so much on one region, like Saudi Arabia, for these big site fees, what if things change politically?
That's a fair question. It definitely creates concentration risk. They need those relationships to remain stable, but the financial incentive is huge.
The fees are just that good.
Apparently so. These fees are often paid well in advance, high margin. It seems TKO feels the potential reward outweighs the geopolitical risk right now. Calculated gamble.
Okay, site fees is one lever. What's the second?
Partnerships. Sponsorships, basically. They've set a really ambitious target here.
Which is?
$1 billion in total company partnership revenue by 2030.
$1 billion from sponsorships alone. That's
Yeah.
huge. How do they get there?
This is where the UFC moving to Paramount Plus becomes so critical again. Remember that massive reach. Over 75 million global subscribers.
A huge audience.
That makes UFC, WWE, PBR, the whole portfolio way more attractive to big corporate sponsors who want massive engagement. Scale matters for advertisers.
So they expect bigger deals, more sponsors?
Yes, and they're already seeing it. TKO mentioned getting inbound calls from brands wanting multi-property deals.
Like sponsoring UFC and WWE?
Or PBR. Exactly. Deals that cut across the portfolio. Think joint ticketing offers, cross-promotion, during broadcasts on Paramount, plus integrated advertising. The goal is to leverage the combined audience. Convert a UFC fan into maybe checking out WWE or PBR and vice versa.
Turbocharge the whole ecosystem for sponsors.
Yeah.
Makes sense. Okay, third growth lever. Boxing. But you said it's kind of two parts.
Yeah, it's important to distinguish. There's the Zuffa Boxing League launching in 2026, where TKO owns the IP, runs the promotion, holds the media rights. That's a long-term content play.
Okay, building a new league. What's the other part?
Super fights. They plan to host like 2 to 4 massive boxing super fights per year, partnering with Sela, the Saudi entity.
How is that different from Zuffa Boxing?
It's a different business model. For the super fights, TKO isn't the promoter taking the risk. They're acting more like a service provider.
A service provider? How?
Think about that huge Canelo versus Crawford fight recently. Generated a $47 million gate, massive viewership on Netflix. TKO sees an opportunity there to basically get paid for their expertise. They expect to earn a service fee, maybe around $10 million per super fight they help facilitate.
Just for helping organize and run it.
Yeah, and potentially getting commissions for negotiating the media and sponsorship deals around that fight, too. They leverage their connections, their operational muscle, but without taking on the financial risk of promoting the fighters themselves.
So it's like high-margin consulting and execution for massive events.
Pretty much. Pure service revenue adding to the top line. Very smart way to play in the boxing space without fully committing to promoting individual boxers and one-off events.
Okay, so wrapping this all up, it really was a transformative quarter.
Absolutely. TKO locked down these massive, long-term, high-margin media deals, UFC to Paramount, WWE to ESPN. That gives them incredible stability.
Rock-solid foundation.
Exactly. Which lets them take on some strategic debt, aggressively return capital to shareholders through buybacks and dividends.
While also investing heavily in these future growth engines.
Right. The site fees, the Zuffa Boxing League, the super fight service model. It's like a well-oiled machine now. Guaranteed revenue funding, calculated growth bets.
They basically charted their course for the next 5+ years, financially speaking.
Feels that way. They have predictability they didn't have before the merger.
Okay, that brings us to our final provocative thought for you, the listener, to chew on.
Let's hear it.
TKO's hitting that ambitious $1 billion partnership goal hinges on getting fans of one sport to watch others in their portfolio, right? Cross-pollination.
Definitely. That's the synergy play.
So with UFC and WWE content now getting centralized on these huge platforms like Paramount Plus and ESPN, how quickly can TKO actually turn, say, a hardcore UFC fan into someone who also watches WWE? Or PBR? Can they really make that multi-sport conversion happen at scale to hit that billion-dollar target?
That's the million-dollar, or rather, billion-dollar question, isn't it? The distribution pipes are there. But changing fan viewing habits, that's the next big strategic challenge. Definitely something to watch.
Indeed. All right, that was our deep dive into TKO's milestone Q3. Thanks for joining us.
Catch you next time.